Over 20 million homeowners in America, nearly 1 in 4, are spending more than 30% of what they earn just to keep a roof over their heads. And that number climbs every single day, which raises the question, can you actually profit while you're paying off your first mortgage? Well, it turns out you can. And it comes down to one number the bank hopes that you never learn to control. My name is Francisco. I'm the owner of Vantage Mortgage, and we've closed more than 400 loans and over $100 million in mortgage financing across Florida and Texas. So in this video, I'm gonna show you how to pay off your first home for tens of thousands less than you're supposed to, and keep that money as pure profit in 4 simple steps. Now, before we get into things, you need to understand what profit even means when it comes to a mortgage. See, profit on your home simply means the gap between what you're making and what you're handing the bank every single month as your mortgage payment. But what nobody tells you about that gap is that your mortgage was never built to help you own your home fast. It was built to pay the bank first. So let me walk you through an example that'll let you wrap your head around this. Let's say you borrow $400,000 at 7% interest rate, and your monthly payment is about $2,660, $2,600 a month. You'd probably think most of that goes towards your house. But not really. In your first payment, about $2,300 goes straight to the bank as interest, which means that only about $300 goes towards what you actually owe. And it stays that way for years. For the first 20 years of a 30-year loan, most of every payment you make goes to the bank, not to your house. So 20 years in, you're 2/3 of the way through, but you've only paid off about 42% of what you actually owed. You still owe around $230,000. And by the end of it, you've handed the bank $558,000 in interest alone. So a $400,000 house ends up costing you $958,000. That's your gap right now. Over $500,000 of your own money that could have stayed in your pocket as profit, sitting in the bank's account instead. And it's not because you did anything wrong. It's just the way that the bank set the whole thing up. And almost nobody ever stops to change it. That's the reason that so many of those 20 million people feel like they're drowning. Because every month, a huge piece of what should be their profit gets handed to the bank, and most of them don't even know it. Now, here's the good news. If we zoom out just a little bit, there are 2 ways to grow it. You either make more money or you pay the bank less. Now, ideally, it would be a combination of these 2. But to be frank with you, I've got no control over how much you make, because that side is completely on you, whether you're crushing it at work or not. But the amount that the bank takes is a completely different story, because that isn't set in stone. It's just a number that the bank picks to protect itself, not to help you, which means it's a number that you can bring down. And that is the whole idea. Getting them to take as little as possible so you can keep as much of your own money as you can. And after doing this for years now, I can tell you that it really comes down to 4 things: the rate, your loan, how you pay it down, and the way that it moves after you close. If you get those 4 things right and you shrink the bank's cut as far as it'll go, that gap of yours opens up wide and leaves you with a way bigger profit slice. So let's start with the first one, your interest rate, because this is the one number that the bank is hoping that you never learn to control. And let's take that same $400,000 loan at a 7% interest rate. You hand the bank $550,000 in interest over the life of it. But if we drop that same loan to a 5% interest rate, that number falls all the way to $373,000, which is over $185,000 that stays in your pocket instead of theirs. And you didn't earn a single extra dollar to get it. Now, here's what most people never realize, because they think that the rate that the banks give them is fixed. And here it is tricky, because they want you to think that it is, but in reality, it really isn't. Your rate is just how much the bank makes off of you. So of course, they're not racing to hand you the lowest one. The rate that you actually qualify for depends on your credit, your loan, and the lender that you sit across from. which means that it's something that you shop for, not something that you just take. And that's the single biggest lever that you've got. Nothing else comes even close, and it's the easiest one for you to get right. And as long as you lock it in before you sign. Now, the second one is the loan itself, because the right loan is what unlocks that better rate, and this is where the bank works against you. See, a bank only carries a small shelf of loans, and their whole job is to fit you into one that they already have, not to find you the one that costs you the least. That's simply just how they're built, because putting you in the wrong loan doesn't cost the bank a single dollar. Quite the opposite. Actually, it decreases their risk. But it costs you, so they'll squeeze you into something and let you pay for it without you ever knowing. For a first-time buyer, most people think that they need 20% down payment, but the typical buyer only puts about 10%, and some loans start as low as 3% down. But here's the catch that the bank will never lead with. If you put down less than 20%, you get stuck paying PMI, private mortgage insurance, every single month, and that money just disappears without ever building a single dollar of equity. So knowing the right loan for you and when you can drop that insurance puts some serious money back in your pocket. But that's not a conversation that a bank is set up to have with you. And if your credit score isn't even there yet, an FHA loan can get you in with as little as 3.5% down payment, which you treat like a bridge. You get in now, you build your credit, and then you move into something better the moment that you qualify for. So that's your rate and your loan handled. And that's the bank's cut taken care of before you ever sign. And real quick, if you find this video valuable so far, make sure to like and subscribe and encourage YouTube to show this video to other people who need it. Now, the third one is how you actually pay it down. And there are 3 simple ways to do it. The first, and this is my favorite without a doubt, is biweekly payments. This is where instead of paying once a month, you pay half of the mortgage every 2 weeks, which adds up to 1 extra payment a year without you ever feeling it. And on that same loan, it pays off your house about 6 years early and saves you over $134,000. The second is even simpler because you just pay a little extra on top. An extra $200 a month knocks about 6 years off the loan and saves you around $126,000 in total, which is quite a lot for the average homeowner. And the third is to use any windfall that lands in your lap. So a tax refund, a bonus, a big check from work, you essentially just drop it in your loan as a one-time payment and it can save you anywhere like $80,000. But this is where a lot of people lose everything that they just gained, because when you send that extra money in, you have to tell the lender to put it towards your principal, not towards your next payment. Because if you don't, the bank just does the opposite on its own. It uses your money to cover future interest, and the whole benefit just disappears. That one phone call is the only thing that's standing between saving thousands and losing it. So make it every single time. The fourth one gives you a second shot at your interest rate, even after you've already got the keys. And there are 2 ways to do it. The first is refinancing, because when rates drop or your credit gets stronger, you can swap your loan for a new one with a lower rate and a lower monthly payment. And that's just more money that you keep. And the second one is recasting. Now, this is something that almost nobody talks about, but after a big one-time payment, some lenders will let you recast the loan, which lowers your monthly payment while your interest rate and your loan timeline stay exactly the same. So you pay less without ever starting over on a new 30-year loan. So those are the 4: your rate, your loan, how you pay it down, and the resets after you close. And together, they shrink the bank's cut and increase your profits. Now, could you also grow that gap from the other side by making more money and putting it to work? Sure. And if you can, you definitely should. But that side is on you, and I cannot do anything about it. My side is the bank side, your rate and on your loan, which is everything that we just walked through. And if there's one thing that I want you to walk away with, it's this. Out of those 4 steps, your rate is the biggest factor that's going to influence how much money you're left with in profit at the end of the month. And it's the one you have to get right before you ever sign. Because once you sign, you're mostly stuck with it. The catch is that the right rate only comes from the right loan. And the right loan depends entirely on your exact situation, your income, your credit, and the property that you're going for. And that's the part where most people either hugely overpay or get told no, when the truth is that there was a loan out there built for them the whole time. Now here's the thing. Those 4 steps, that's your foundation. And they'll already keep a small fortune in your pocket. But your rate is the one that moves the needle the most. And it's also the one that I couldn't really do justice to here because it comes down so much to your exact situation. So check out this next video where I walk you through exactly how the right loan gets you the right rate, why the bank keeps turning good people away, and how to find the one that actually fits you, so you can keep that money instead of handing it to the bank.